in class sessions for the subject of indirect tax paper, in which we are going to discuss GST valuations relating to value, which is third. The value, it says that the government shall notify. Section 1 says that wherever no value is notified, your first preference is your own transactions value to be accepted. There are three conditions: one implied, two express. The implied condition is there should be a value, there should be a consideration. If the supply was made without consideration, that is, if it is a schedule 1 supply, then section, because if there is no value, 15.1 cannot apply. Then you have to come to 15.4, that is the value as per valuation related to each other. And third, price shown in the invoice and records is the only consideration that the buyer pays to the supplier. There is no other consideration flowing directly, indirectly to. If all these conditions are met, then you satisfy 15.1. You take your transactions value, that is the value reported by you in the invoice, subject to changes in subsection 2 and subsection 3 of section 15. What does subsection 2 and 3 deals with? 2 deals with certain expenses, certain cost to be added, and 3 deals with discount to be subtracted. Now, subsection 2 says price if they are not included in the price. What are these 5 elements? First, any type of indirect tax other than GST. I gave you the most common and practical example, that was of customs. So wherever goods are imported, whatever custom related duties are levied, you add it in the value or late fees beyond the agreed due date. That particular payment is added in the form of interest, and that is exclusively on account of making the late payment. Such interest, such penalty has to be added, has to be treated as part of the value, and GST paid on that. That is clause D. Now clause D has a cross reference whereby what clause D is saying is also provided or also studied by you in the chapter of time of supply, where it is said that the time of supply for such additional consideration in the form of interest, late fees is the date when it is actually received. Similarly, you also have to understand and keep in mind one thing, that when we are saying that this interest or penalty is part of the value, it is to be added to the value. It also means one thing, that this interest will not be taxed as a separate supply. It would be considered to be part of the original supply. And at the same time, you have to link it to one more chapter, that is exemption, where we studied that certain interests are exempt, but the interest which is exempt is only limited to interest on loan, deposit, advances. This interest which we are talking about is not on loan, deposit, advance, and hence it is also not falling in the exemption chapter. Then comes clause E, which deals with price linked subsidies. So where you have reduced the price. Again, this is important because we have seen that only where these elements are not part of the price, then you have to add it. So if you have reduced your price for any subsidy which is granted by any authority except the central or state government, the price reduction on account of subsidy is to be reversed, if I can say, or is to be countered as per clause E by adding back the amount of subsidy to the transaction value. So Clause E requires me to even consider such price-linked subsidies as part of the value. Now, there are two important points. One, it should be a subsidy which should be leading to reduction in price and not a subsidy which is provided in the form of some type of financial assistance or some type of capital subsidy or subsidy in the form of reduction in any of my expenses like interest, etc. If I receive any such subsidies, that are not required to be added. Another point which is provided as an explanation, that this subsidy, even if received from a third person, shall be added provided it is received by the supplier. If the subsidy is received by the buyer, it should not be added in the value. Now, I linked this subsidy point with the consideration definition. If you recall consideration definition, it also makes this very clear that consideration may flow either from the recipient or from any other person. The only thing to be established is that the consideration should have a direct linkage with price. If the consideration, sorry, not price, supply, if the consideration is in response for the inducement of, as a, you can say, a counter to the supply, then only it is considered as a consideration. If it has no direct linkage with the supply, it will not be considered as a consideration. Hence, only price-linked subsidies which have a direct linkage with price and which can be said to be in respect of for the inducement of supply, only that shall be considered. And even if the subsidy is coming from a third person, not from the recipient, it shall be considered again as per the same definition of consideration. And the explanation which is given below clause E makes it very clear that the supplier should receive this subsidy. So if this subsidy is received by the buyer, I gave you example of cylinder subsidies, which the buyers get in the form of or similar to what we say cashbacks. So if it is coming to the bank account of the buyer, then it is not to be considered as part of value by the supplier. So this is all about clause E. Then we went to clause B and C. In that we first studied C. C is the most common clause where if you are charging for any other activity that you have done for this supply, that has to be added to the value of supply as per section 15(2) clause C, read with the concept of composite supply mixed supply taxability under section 8. So what is this point? So let us say I am providing you CA services. Let us say you want to file an appeal and I will be filing that appeal. You have appointed me for filing this appeal. Now when I am filing your appeal, in this particular case, for the purpose of filing the appeal, I will be incurring some additional cost in the form of printing the number of sets for appeal. Then filing, at the time of filing, there are some charges, there are some fees that has to be paid. Now, all these expenses I load in the invoice as out of pocket expenses. Many times, if you know that whenever we are traveling as professionals on behalf of the client, we add the traveling cost, we add the accommodation cost. All these are those expenses. This I'm giving you example relating to services. Last time I had given you example for goods related transactions, which includes, besides the value of goods, the additional packing charges, the loading unloading charges, the transport charges. So these are the common expenses which clause C covers. Clause C simply says if there is any additional amount which the supplier charges to the buyer, and again that is a part of this supply, and it may be done either before or at the time of supply. So in short, for the purpose of completing the supply, if I can say, whatever additional expenses, whatever additional cost the supplier is charging, that is to be added in the value as per clause C, and this has to be read in accordance with the concept of composite supply. Because even the concept or the taxability given in section 8 says that wherever there is a composite supply, where multiple things are done or multiple things are supplied, then for everything combined, the tax rate will be only of one item, which is the principal supply, provided these all other items are naturally bundled. So you can link clause C with composite supply concept. Both are talking of similar provisions under the law. And then comes the slightly tricky, slightly misunderstood clause, clause B, which says that whenever any expense was supposed to be originally incurred by the supplier, it was the expense or responsibility of the supplier. However, due to some intermediate changes, due to some unexpected, unforeseen events, that particular thing is done by the buyer. Then, whatever expense the buyer has done, obviously to that extent, supplier would have reduced his value. Again, if there is no reduction in value, none of these additions apply. So again, I start with the first point that all these additions are subject to the condition that the value charged by the supplier is excluding this. It is lower and it does not include these amounts. So if a particular expense, which was originally the responsibility, the obligation of the supplier, but it is met by the recipient, that should be added. That is what clause B says. Now, what clause B does not covers, which we also saw in the form of circular, on which, in fact, we had discussion where a similar example was given by Geet, that if the recipient is providing some raw material, some packing material, which I have to use in manufacturing the final goods to be supplied to that recipient, whether the cost of those inputs, packing materials supplied by the recipient will be included in the value as per clause B. The answer is that it depends upon whether this packing material, raw material, maybe any type of mold dye, was originally to be expensed by the supplier. If originally, as per the original contract, supplier had to do it, but because of some problem, supplier was not able to procure this, hence the recipient did that and provided it to the supplier, then only it will be included. However, if originally the contract was such that the buyer only would provide these items, and many times the contracts are such that I will be manufacturing a particular product, but in that product, certain things required would be provided by the recipient. If this is originally the contract, clause B does not apply. So all this is about the transaction value concept and the various additions. Now we come to section 15.3, which is again linked to transaction value, but it talks about only one deduction or subtraction from the transaction value, that is on account of discount. Now, wherever the supplier gives discount to the buyer, that discount has to be reduced. Now, there are two categories or two types of discount made out in 15.3, subclause A, subclause B. A says it is the discount given at the time of supply which is recorded on the face of the invoice. So in the invoice itself, we show it as a deduction. It will be deducted, no questions asked, no conditions attached. However, if it is B, where at the time of supply, I charge the full price, and in future, after 1 month, 2 months, for some reason, for some condition which is already agreed before or at the time of supply, I give you a discount in the future. So originally my first invoice is of entire, let us say 1 lakh. Now I have to give you 10,000 discount in future after 2 or 3 months. This 10,000 discount will be reduced from the value subject to two conditions. One, there has to be pre-agreement. Two, it has to be recorded, reported by me using a proper document, and the recipient has to reverse the corresponding ITC. Now, in this clause B, the two conditions, the first condition I informed as per the latest GST Council meeting will be removed. And in the second condition, where the word is not given as to which document I should issue, they will be linking this with the credit note provisions under section 34. So here they may be adding in section 15(3)(b) subclause 2 that I have to issue a credit note and credit note as per section 34, which is a GST credit note. So this GST credit note will lead to reduction of my sale value, and commensurate reduction has to be done by the recipient in the recipient's ITC. This is what is 15(3) requirement. Now 15(1) is dependent upon satisfaction of three conditions. There is a price, that is, there is a consideration, it is not a free supply, it is not a schedule 1 supply. Buyer seller not related, price is the sole culprit. Sorry. Now, if any one of these conditions are not satisfied, or if any one of these conditions fail, entire 15(1), 2, 3 goes out of picture. And in such cases, you have to come to 15(4). Now, what does 15(4) says? If 1, 2, 3 fails, you will be computing value in the manner prescribed, which is as per valuation rules, and this is as per 15(4), that where transaction value fails, you compute value applying the valuation rules. Now today we will be discussing these valuation rules in detail, and these are the most important concepts, students, if you look at it from the exam point of view, because in valuation chapter, a major, you can say, thrust from exam point of view is on the valuation part, is the valuation rule part. Obviously, what I explained to you relating to 15(2) and 3, they are equally important from the point of view of case study questions. But valuation rules are also important because you may be required to apply one of these valuation rules. Now, as you can see on the screen, these valuation rules are provided in Rule 27, 28, 29, 30, 31. Up to 31, you have generic valuation rules. And then after this, 31A onwards, you have specific valuation rules. Now, what is the difference? As you can see, 31A, it deals with a particular category, lottery, betting, gambling. 31B, online gaming. 31C, actionable claims in casino. 32, again determination of value in respect of some specific supplies, and here when you read, you'll find it is for some specific supplies like conversion of currency, then booking of tickets by air travel agent, then life insurance business. So all these are specific valuation rules starting from 31A. So we divide the valuation into two parts, specific and generic. Now, what is the difference between specific and generic? If you remember, students, now understand this technically first. There are two provisions, 15(4) and 15(5). What did 15(5) say? 15(5) said that for some specific supplies, the value shall be in the manner prescribed. Those specific supplies are from 31A onwards. And what is 15(4) saying? That where conditions of 15(1) are not satisfied, value has to be determined as per valuation rule. So that is generic. It can apply to supply of anything, any goods, any service, anything. So understand the difference. Technically, all the rules from 27 to 31 are under the aegis of 15(4). And all the rules from 31A onwards are under the aegis of 15(5). Technically, though it is interesting to note that this technical point has a defect. What is that defect? I'll explain later. But please understand that this entire set of valuation rules is coming from two different sections, 15(4) and 15(5). Correct? So we first go to the generic valuation rules. Now these generic valuation rules are helping you to determine the value whenever 15.1 fails. And when 15.1 will fail, one, no value is there, that is, it is a free supply, it is a schedule 1 supply. Two, buyer and seller are related. Three, besides the price you have shown, there is some additional consideration which the supplier gets directly, indirectly. In such cases, 15.1 fails. What is 15.1? The value shown on your invoice, the transaction value is not accepted. So that is 15.1, taking the transaction value, it fails. And in that case, you go by the valuation rules, that is 27 to 31. Now, when we talk about 27 to 31, you have to apply these rules in a sequence where 30 and 31, which is in front of your screen, are the rules which are applicable in all the above valuation rules. So 27, 28, 29, in all the three cases, you'll find reference of 30 and 31. So 30 and 31 are, you can say, a type of residuary rules which are made applicable in all cases. So we'll first study 30 and 31, and then we will go to the main rule 27, 28, 29. We'll try to take practical case scenarios to understand the applicability of those rules. Today, who will be doing the reading for me? Yes.
Sir, may I?
Sorry, I cannot see. Okay,
Hello.
Ankit.
Yes, sir.
Ankit.
Yes,
Great.
sir.
Where are you from, beta, Ankit?
Sir, I am from Bihar, sir.
Acha, excellent. I was there in Patna last week. Where
Oh,
in Bihar?
great, sir.
Where in
Uh,
Bihar?
in Mad in Madhubani district.
Oh, Madhubani. Great, great, great. Chalo, Ankit, please read rule 30 and 31.
Okay, sir. Rule 30. Value of supply of goods or service or both based on cost, where the value of supply of goods or service or both is not determined by any of the preceding rules of this chapter. The value shall be 110% of the cost of production or manufacture or cost of acquisition of such goods or the cost of provision of such services. Rule 31. Residual method for determination of value of supply of goods or services or both, where the value of supply of goods or service or both cannot be determined under Rule 27 to Rule 30, the same shall be determined using reasonable means consistent with the principles and the general provision of Section 15 and the provision of this chapter, provided that in the case of supply of services, the supplier may opt for this rule, ignoring Rule 30.
Now, understand this. I'll repeat, students. 30 and 31, both are residuary rules. What do I mean by residuary? See, residuary means where the main rule fails, still the law has to provide a mechanism. So it provides something which is the residuary rule. What is residuary? Ki where the specific provisions or the specific methods cannot be practically applied, are not practically possible. So you determine the value as per this. Now, if you observe rule 30 is a costing based rule. Why? Because what has rule 30 said? First, it says that where the value of supply of good service cannot be determined by the above rules, that is from 27 to 29. If you cannot determine the value will be taken as 110% of cost of production or manufacture. This is for goods. And if it is service, cost of acquisition of such goods, or where it is service, it is cost of providing the service. Now, let me first give you the background. This provision has come from the central excise. In central excise valuation also, we had a similar rule which said that you simply do one thing. Anyways, manufacturing industries do their costing. So prepare a cost sheet, find out the cost of production. Now, if you all recall your cost sheet, you have prime cost, you have factory cost, and then you have cost of production. After you add all expenses up to administrative overheads. So that cost of production will be the basis. So in short, you're only not adding one expense, that is the selling distribution related expense, because obviously there is no sale Hence, there is no question of adding selling and distribution cost. In excise, this rule was mainly provided, if I can give you the backdrop, for captive consumption. What is captive consumption? Where I'm not selling the goods to outside person, I'm producing and I'm myself using it within the factory. That is captive consumption. Now, let me tell you, students, just for your interest and knowledge, excise was applicable even where the goods are manufactured and consumed by me myself. So even if I'm not selling it to anyone, excise was applicable because excise was not linked to sale. Excise did not require there to be two persons to be a transaction. Excise was applicable on manufacture and demanufacture, and excise liability triggered on removal of goods from factory. It did not require sale. So in excise, even captive consumption was taxed, and for captive consumption, this was the rule. Now, what they have done under GST, that they have made this as a residuary rule. So where your main rule 27, 28, 29 fails, you can take this as the rule. Now, why they have made this as a residuary rule? Because see, practically what you are going to study in 27, 28 may not be possible. It may not be feasible. When we'll discuss that 27, you'll realize why what is given in 27 may fail. Hence, they said that okay, if all external values are failing, still what you can always do is you can go back to your books, do your costing, and from the cost, you can determine the notional, if I can use the word notional value. Why? Because actual values are failing, but I have to take some tax. So let me take a notional value. So this is what is the purpose of Rule 30. Now here it has been provided that this cost of production has to be determined as per cost accounting standards. So like how we have our financial accounting standards, you have cost accounting standards. So cost accounting standard will provide or has provided the mechanism of computing cost, and following that mechanism you determine the cost of production. So students, it is nothing but your CA interlevel cost sheet. That cost of production, add 10%. Now what is this 10% towards? I'm sure you'll understand. It is towards your general profit margin. So law assumes that there is a profit margin of 10%. So adding that, they say this will be your taxable value. Now, interestingly, what they did in GST, which was not there earlier, as I said, this is drawn from the excise valuation. In excise, it was only 110% of cost of manufacture or production. It wasn't cost of acquisition. It wasn't cost of provision of service. See where this cost of acquisition applies? When you are doing trading, you're not doing manufacturing. Then whatever is your cost of acquisition means the price at which the goods have landed to your shop. That is cost of acquisition. On that you add 10% as the margin of your profit. It becomes your taxable value. So this part was not there because excise did not cover non-manufacturing activities. Plus, since it did not cover services, hence the last part also was not there. But now in GST, since we have to cover all types of transaction, manufacturing, trading, service, hence in this rule, they have included this that you will take 110% of cost of acquisition and 110% of cost of providing the service. But as you all know, even in our cost sheet chapter, finding out the cost of service has always been very tricky, has always been slightly, if I can use the word, difficult. And there is a possibility that finding cost of service or doing costing of service may not yield a good result. Like taking example of our own CA office. In CA office, we are providing so many services to client, right from starting from the present income tax return filing, then later on income tax audit, GST returns, consultancy. There are so many things. Now it is impossible, I should say, to determine what is my actual cost of the service which I have provided to the client. Why? Because see, costing can be done of physical things. Like you can take my infrastructure cost, you can take my employee cost. But what is the cost of my knowledge, of my experience, of my expertise? That is always a question mark. Hence, costing of service, especially in case of intellectual services like ours, is highly impossible. Hence, if you see, Rule 31 has a proviso which says that in case of supply of service, the supplier may opt for Rule 31 instead of 30, because the Act also understands that it is possible that 30 may not be very relevant for services. So they have said that for services only, the supplier has the option of not following 30 and directly coming to 31. Now, what is 31? 31 is actually the residual method, or the, you can say, the last resort method, where they have not provided any rule. I repeat, they have not provided any rule, or I should use the word, they have not provided any method. So as you can see, what does Rule 31 says? It generically says, it very open-endedly says that where value cannot be determined as per any of the above rules, the same shall be determined. How? Using reasonable means consistent with the principles and general provisions of section 15 and other provisions of this chapter. That's it. So there is no method, no mechanism given. Now, practically, this rule is not applied anywhere. Why? Because there is no methodology given, there is no calculation given, there is no mechanism given as to what should be added, what should be included, etc. But then still this rule is required. Why this is required? Because if there comes a case where it is highly impossible to determine the value by any of the rules, then at least the law should provide a value, because if the law does not provide a value, the law itself fails. Let me just inform you from litigation point of view, there are multiple judgments. If I have to give you the citation, the mother judgment is Govind Saran Gangasaran. In this judgment, the Honorable Court said that there are four legs on which the taxation will stand. And if any of the leg is missing, the taxation will fail. One of the leg is valuation. And on the basis of this judgment, Govind Saran, Ganga Saran, you have multiple decisions under income tax, under excise, where the law has said that if the law itself is not able to provide for the valuation, there cannot be a tax. So I may have done a taxable activity, but if it cannot be valued, there is no tax. To overcome those decisions, you have this final last resort option where, okay, everything fails, let me do something. Now, how this rule is applied, that I will explain when we take up Rule 2728, because over there, once I first explain what are the valuation mechanisms provided in the law, then I'll give you practical example how Rule 31 can be applied practically. But if you read it bare, here you will find no mechanism given. There is nothing provided as to how valuation has to be done. So it has been kept very open-ended, very generalized, and I believe that is the only way how a residuary method can be done. So 31 is the last resort rule, where using your judgment with all the provisions in mind, you have to find out some value. This is what is Rule 31. Now, we come to Rule 27, 28, 29. Now, you'll observe that we had three conditions, correct? For accepting transaction value, one, there has to be a value. Two, buyer seller not related. Three, price is the sole consideration. Now, when any of these conditions are not present, you will drop 15(1), that is, you will ignore the transaction value and you will come to the valuation rules. So, keeping that in mind, you have to read these valuation rules, that these rules have to cater to the conditions where 51 fails. So, we have three rules, and you have to now read these rules keeping that scenario in mind, that okay, if this condition fails, I'll come to this rule. If this condition fails, I'll come to this rule. Correct? Okay. Please read, Bada. Rule
Yes, sir.
27.
Rule 27. Value of supply of goods or service, where the consideration is not wholly in money. Where the supply of goods or service is for consideration not wholly in money, the value of supply shall be clause 1, clause A, the open market value of such supply, clause B, if the open market value is not available under clause A, B, the sum total of consideration in money and any such further amount in money as is equivalent to the consideration not in money, if such amount is known at the time of supply. Clause C. If the value of supply is not determinable under Clause A or Clause B, the value of supply of goods or service or both of like kind and quality. Now, Clause D. If the value is not determinable under Clause A or Clause B or Clause C, the sum total of consideration in money and such further amount in money that is equivalent to consideration not in money as determined by the application of Rule 30 or Rule 31 in that order.
So they have given four mechanisms. Most important, this A, B, C, D has to be applied sequentially. So you will strictly first apply A. You cannot go to B or C or D. So only where A fails, you'll come to B. Where B fails, you'll come to C, and where C fails, you'll come to D, and D is nothing but your last two values, which I said that they are the residual method. That is 30 is what? Costing method, 110%, and 31 is no method. It is just saying you have to determine value using some reasonable method. Now, what are these values? A, B, C. In that, we have to understand certain definitions. But before I go to those definitions, you have to first tell me when these rules are applicable. So 27 says value of good service where consideration is not wholly in money. 28 says value of supply of goods or service or both between distinct persons or related persons other than agent. And 29 says where the value of supply is through an agent. Now, we had three conditions. What are those three conditions? There is no price, buyer seller related, and price is not the sole consideration. Now, when any of these fails, I said you will come to these rules. First, let us understand when which rule will apply. So, first scenario where there is no price means it is a schedule 1 transaction, that there is no price. Which of these rules will apply? Which of these rules you will apply?
Rule 27, sir.
Open
Supply
market
without
value of the
consideration.
supply. Open market value.
मेरे पास 27. Okay. Nee, see, don't say open market value or what. I just want to understand whether 27, 28, 29, because in all these three, the same terms are used. Even if you see 28, it has again used the same thing. You'll use open market value, etc. So the mechanism given is same. My question is, which rule will apply? So where there is no price, which rule will apply?
Rule 27, sir.
27.
Okay. But 27 says, if I'm not wrong, value of supply of goods where the consideration is so something. It means there is a consideration in case of 27.
So rule 28.
So whether 27 will apply or not, Swaminathan? Because others are saying it is 27.
Here the consideration that is received partly in cash, not wholly in money, right? So 27 will apply. So, without consideration means then no cash is received.
Correct. So my question is, where we are talking about schedule 1 supply, out of these rules, which rule is applicable?
I feel it is 28 is appropriate.
28.
Yes, sir.
Okay. Others?
I feel it is 27.
But
Because
27, see, 27 says what? I'll again repeat. 27 is saying, as you can see the heading, where the consideration is something. Means 27 is applicable where there is already a consideration. No? And we are saying no supply, we are saying, I'm asking the first question that where there is no price. Why we are coming to valuation rule? Because the very first condition, the implied condition of section 15 is failing. What is that condition? 15 applies, 15.1 applies where there is a price, and I am saying there is no price. Why no price? It is a schedule 1 transaction. In schedule 1 only you don't have a price, correct? You don't have a consideration. That is what is schedule 1.
But here it says where the consideration is not wholly in money.
But there is a consideration. So see, what do you mean by this is what I want to discuss firstly with you all. See, answer inside the rule is another part. Anyways, as I said, if you see in all the rules, more or less the same answer is given. You will take open market value, etc. One or two things here and there are changing, but majorly the methodology given in the rules is same. What is important is which rule you apply. Now, you are saying, it is saying where the consideration is not in money. Agreed. It means that it is in some other form, but it is there, na? Are you getting my point?
Yes.
It means it is in non-money form. Instead of paying for my services, let us say I did your entire income tax computation along with your tax audit and all. Instead of giving me fees of 25,000 rupees, which is in monetary form, you are dealing with, let us say, in cloths. Your business is of trading in good quality of trousers and shirts. So what you did is you gave me 2 shirt pieces and 3 pant pieces of a very high quality. You said that, sir, keep this as your fees. That is where 27 will apply, or where there is no value. That is the schedule 1 cases. That is where 27 will apply. This is what we are discussing.
But in Rule 28, it should be between distinct or related persons.
Agreed.
Then it will
Agreed.
apply in that case only.
Okay.
Not in general. Okay. When
So
we
again,
supply to others.
So again, my question is, when will, see, what I'm trying to make out is, we have 3 conditions in 15.1, and we will come to these rules, which is under 15.4, only when one of these 3 conditions are not met. Correct? This is what we have been discussing from previous class. Today also I started with revising the same points again. Now my question to y'all is, I want to identify that if one of these conditions of 51.1 is failing, because of which I am coming to these rules, I want to know for which condition failure I'll apply which rule. So my first condition was that there is no price. And when there is no price, it is only the case of schedule 1. Only because otherwise without price, the supply itself will not happen. But supply is happening and there is no price. It means we are exclusively talking about schedule 1 cases. So now I ask the first question, if it is no consideration supply, that is, it is a schedule 1 supply, then out of these rules, which rule you will apply? Many people said 27. Then somebody said 28. So I argued, I gave my examples. So Chitra, when you are saying rule 30, if you see rule 30 is also part of 27, 28, 29. In fact, it is a residuary rule given in 27, 28, 29. In short, Chitra, I'll put it like this. You have only 3 rules. Okay, I'll now give you another this. So firstly, we are clear that it is a transaction. It means we are discussing about schedule 1. Try to recall. You want me to open
Is between related party
and distinct persons. That is second part.
person,
And third part is principal
supply.
agent,
Yes, sir.
person, distinct person. Taken care of in which rule? Rule
28.
28.
28.
Then point number 3, supply of goods by principal to agent, by agent to principal. This is taken care of in rule 29.
29.
Value of goods made or received through an agent. So schedule 1. In schedule 1, whatever entries are covered, out of that, the third entry, which is for agent scenario, for that you have specific rule 29. For the other two entries, that is entry 2 and entry 4, which requires transaction between related parties or distinct persons, that is specifically covered in. What is that first transaction? The first transaction is permanent transfer or disposal. Whether this will cover in 27, because everybody said 27, or this will be covered in 30 as what Chitra said. Now, third breach. What is the third breach? Should be able to know which rule will apply. Students. Yes. So if you are not having any counters, so should I take it as your deemed approval to whatever I said?
Yes, sir. Agreed.
So it means you are agreeing. Approved. Okay. I thought I'll get some counters. Okay. Now, please understand when Rule 27 applies. So it will apply mainly in case of breach of the third condition. That is where, besides the price which is shown on the invoice, I am also getting something which is not shown in invoice. And generally the possibility is that it is in some other fashion that is not in monetary form. Second, Rule 27 will also apply to a scenario where the price is reported in the invoice, but the price is in the form of money plus non-money form. I'll give you an example of this. So let us say we all, I'm sure by now, know the concept of joint development agreements, JDA, correct? Where there is a landowner, there is a builder developer, they both come together, and the transaction, at least how it is viewed by the lawmakers, is that the landowner has given the development rights to the builder, and against the development right, the builder may pay in monetary form, but many times what builder does is it may not pay in monetary form. It pays back in the form of giving some constructed flats or shops in that whole building to the landowner as a consideration for landowner's transfer of development rights. Or many times the builder does that some amount the builder will pay in money form, and the remaining amount the builder will pay in the form of any type of these flats and all. Now, this is one example, the real life example, which fits in section 27. Another real life example which will fit in section 27 is section 15.2b. What is 15.2b? 15.2b is saying that where anything is done by the recipient, any expenses made by the recipient which was originally supposed to be done by the supplier. In such cases, 15.2b applies. And 15.2b says that whatever expense or whatever is the amount spent by the recipient should be added in the transaction value. Now, there is a possibility that what recipient has done, recipient has provided some raw material, like in our last class example, the chip required in that mobile phone handset, that recipient has supplied from his side, which originally should have been supplied or procured by the supplier, but he was not able to procure. So recipient said, okay, I will procure from my sources and give it to you. Now that is what is given by the recipient to me, which is in a non-monetary form because it is in the form of some goods, that is the chip. Similarly, another case scenario which will come over here in this particular case is that where along with monetary consideration, I receive from you something which is in non-monetary form. So mainly it covers the cases of barter. If you remember, supplies definition covers barter. Like here, if you see, few examples given by our module are most real life common examples that when you go to buy a new phone, many times what you do is you do exchange. You give your old phone, and against that you buy the new phone by paying some differential price. That is again a common example. Another example given over here is where a laptop is supplied for 40,000. along with the barter of a printer that is manufactured by the recipient and the value of printer known at the time of supply is 4,000, etc., etc. So where there is a barter, where there is an exchange, these are also real life scenarios which comes under this particular rule. So this rule will apply whenever there is a consideration. So it is not falling in schedule 1 cases. There is a consideration. Only the thing is that consideration is not fully in money form. So either there is no money consideration at all, or partly there is money and partly there are non-monetary forms of paying the consideration. Now, when this happens, the rule says where the supply of goods or services for a consideration. So there is a consideration. The only thing is it is not wholly in money. Then the value of supply will be in this sequence A, B, C, D. Now here there are some terms which we need to understand. One is open market value, first term. Second term is goods or services of like kind or quality. Let us first understand these terms. I think they are explained below also. Yes. Can you please read, Beta, the definition of open market value?
Yes, sir. Open market value means full value of money excluding taxes under GST law payable by a person to obtain such supply at the time when supply being valued is made, provided such supply is between unrelated person and price is the sole consideration for such supply.
Okay. Next definition is of the word
What
supply of
is
like
supply
kind.
of like kind and quality? Supply of like kind and quality means any other supply made under similar circumstances which is same or closely or substantially resembles in respect of characteristics, quality, quantity, functionality, reputation to the supply being valued.
Okay. So these are the two definitions. I'm not explaining any one of them. I want you all to now understand this rule. So the same rule is reproduced here. So what does rule 27 says? I'll give you a practical example. For this practical example, you have to give me the answer applying this rule. So same example which I gave few minutes back. You have come to me. I'm your tax consultant. You have come to me asking me to prepare your income tax returns. I said, okay, fine. Now, the fees which I charge is 25,000. However, what you have done is you have instead given me what you sell in your business. So it is like a barter against my expertise services of doing your income tax computation and filing your income tax return. You have given me 2 shirt pieces and 3 trouser pieces, which is what you sell in your business. This is what you have given to me. And let us say you have given to me 5,000 rupees. So when I say or when I ask you to pay the fees, you said, sir, I will pay you the fees in this fashion, and I agree to it. So I take 5,000 plus this cloth pieces. Now this is what is the transaction which fits in rule 27. Now you tell me, applying this whatever is given, A, B, C, D, how will you find out the value? Or what will be the value? As per A, as per B, as per C, as per D.
Yeah, as per B. As per B.
Okay. You can explain anyone. Actually, you have to go in sequence. You have to first take the value as per A. Where A is not possible, A is not feasible, then you will go to B. But fine, I'm okay. Even if you want to explain any alternatively, it is okay. But you have to explain with this example in mind.
Yes, since open market value of this supply of fees may not be determinable, then we will go to B.
Yeah, but what is
Because
open
we,
market value? What is that meaning of that? In my example, what is open market value? Because I want to understand these rules practically in real life scenario, not academically. So I've given you a simple real life scenario. For this 15 September due date of filing returns, you had come to me. I've done your computation. I filed your return yesterday. Now today you are coming to me for paying fees, and you have given me 5,000, which is money, and 5 pieces of cloth from your shop. Now I want to pay GST on my services, so I will have to value this. For this, I will come to Rule 27, which is the applicable rule.
The valuation cannot be done of these services we are providing. Because in open market value, it says at the time when the supply being valued is made.
So what is open market value? This is what I want to understand. You all can go back to the definition. I have no problem.
The full value of money, excluding taxes under GST law, payable by a person to obtain such supply at the time when supply being valued is made, provided such supply is between unrelated persons, and price is the sole consideration for such supply. So here I think it may not be valued correctly. So we will go to B.
No, but I'm still repeating my question, Bida. I have not yet understood what is this open market value meaning. Means, what is open market value? You are saying it is not applicable, fine. So you have analyzed something. But I should also be convinced, others present here should also be convinced that, okay, open market value is not applicable. For that, we need to understand what is open market value. Then we'll proceed to B. Na? So simply, there are 4 methods given, A, B, C, D. You have to give me with this real life example in mind, what will be covered in A, what will be in B, what will be in C. And whatever will is covered in all these, then one by one, we'll try to check whether that what is covered in A is possible. If not, we'll go to B. If not, we'll go to C. So what is covered in A? Give me the real life example with this example in mind. In this example, what could be the open market value, which you are saying is not possible. So we go to B.
Sir, in this example, open market value will be 25,000, excluding the GST, which is payable by the recipient of service of ITL, means who is receiving the service of ITR services. And
Okay.
both
So
of
it
those
means you are
persons are
saying that
unrelated.
open market value is available and I will go by A only.
Yes, sir.
Okay.
And both of those persons are unrelated, and price is also the sole consideration.
But how did you find out this 25,000 beta?
It is the value of supplier which has supplied the services, no?
Okay, so let us make my example more specific. So I have 5,000 clients for whom I am filing this return. Out of this, you are the client about which we are talking about. Correct? You run a cloth shop. You have all good quality cloth, and you know that I have great liking for different varieties of cloth. So you are my regular client. You come to me. You have come to me 1 month back. You gave me all the details. And after doing all the computations and all the uh, deductions, exemptions, everything, yesterday we finalized your returns. We filed the returns. You paid the tax online and the returns were filed. Today you come to meet me and you bring along with you 5,000 rupees and these 5 cloth. So when I was supposed to discuss with you about the fees, you said, Ki, sir, I am giving you this as the fees. I know you like clothes. So instead of giving you money, I thought I'll give you the best quality clothes available in my shop. I also just look at the clothes. In my mind, I do my calculation and I was happy receiving this. So I said, fine, done. So your fees for this year is complete. This is how our transaction happened. Now I have 5,000 clients. For all 5,000 clients, some are salaried, some are pensioners, some are retired with only house property and interest income. Some are people like you who are having business incomes but not covered in tax audit. So I have these multiple type of 5,000 files. You are one of them, and you have paid your fees in this manner. So, see, I partly agree with this point that clause A may not be applicable fully. But why? See, understand what is clause A. See, whatever definition is written over here, it is too academic or too theoretical. If I have to give you practically the meaning of open market value, what it is the full value of money payable by the recipient to get this supply. Simple. Means it is not the fair market value. I am using another term. It is the true and complete value of the service which I have given to you. And obviously, the value is before GST because GST will be added later on. So it is the value of my service given to you. That is, in simple words, open market value. Now, importantly, what I am giving to you need not be the service which I am giving to remaining of my clients for whom I am doing return filing. I hope you all will agree. And that is why I've purposefully taken this example, because that is very much close to all of us. In your articleship, you would have seen this day in, day out, whenever you all have filed returns in your articleship, that no two clients' returns are same. So whatever, even though let us say both are in business, adding further, both are in the same line of business. So let us say I have more three clients who are having the same shop like yours. In fact, they are your competitors, but all are with me. Still, what I have done in your returns is not equally applicable to others, because reason one, their quantum of business is different from yours, even though the line of business is same, but the quantum is different. Second, you are also having share trading. Maybe the other three are not having. The other three, one of them is also having some HP income, which you all are not having. So within one return, what is my efforts, if I have to say, is not the same. So open market value is nothing but the true value of my supply given to you, or my service done for you in preparing and filing the returns, for which the value cannot be identified by comparing my price for others, because firstly, my price for all will not be the same. It will be different. When this open market value will come, where I have a standardized goods, generally this will be applicable more in case of goods. I have standardized goods, or let us say even in case of service, my services are standardized, which means that the service which I'm giving to first person, the same is given to second, and the same is given to 10th, and the same is given to 15th. So I have standardized products, maybe goods, maybe service. So where my products are standardized, so whether I sell to you or to him or to her or to any other person, the open market value will be the same. So open market value, firstly, is what? It is the value of my goods and services which I sold to you, and how this value will be determined. If the same goods, if the same service I am selling to others also, who are unrelated person, from whom I have charged complete price, that is the last two conditions, and the price which I am charging to others is at the same time when I have supplied the goods to you or the service to you. It means there is no time gap also. Why time gap condition is important? Because with time gap also the price may change because of inflation and other reasons. So Today only I have sold the same goods to 10 other people, and you are the 11th person to whom I am selling the same product. The only thing is that instead of you paying me in money, you paid me in kind. So for determining your supplies value, I'll take the value which I charge to other 10. And since my goods, my services are standardized, there is no problem. So what is open market value, students? Understand this practically. It is value of your goods, your services, which you have sold to others. Like how I have sold to you, I've sold the same thing to others. The goods and services which I'm selling to you is the same goods services I'm selling to others. There is no change. There is no difference. Then whatever price is my standard price will be the open market value. Now I said in this example, open market value, I will agree partly that may not be possible. Why? Because I just explained I have 5,000 clients for whom I am filing the returns in this particular income tax season. So this third condition is being satisfied, that the supply is at the same time. But still, what is not getting satisfied is the first two part. What is open market value? It is the value of your supply. That is the supply which I have made to you. And the supply which I have made to you is different from the supply I'm making to the remaining 4,999 clients. Because everybody's return has some difference. In that particular case, I don't have a standardized rate. So in case of all, you'll see chartered accountant, this majority times for such services, there may not be a standardized rate. That is why I said I partly agree to this point that yes, A is not applicable. But what is the other part where I'm saying partly I'm agreeing? It means the other part is also there, that many times out of these 5,000 clients, I have around 1,000 clients who are salaried and who are at the same designation and drawing the same salary with the same component. So many times you'll find that. Now, see, all this is, you'll understand if you fall back to your articleship days. You would have found that in salary returns, many times you have hundreds of files where everything is same. In fact, the employees are also belonging to the same company, same organization. So their entire salary breakup is same except with the change in values, depending upon how many days or months that person was present and all. But otherwise, the components are same. All are getting HRA. All are getting the different types of same allowances. Only the amounts are different. Then, even in your offices where you have done your articles, you would have seen that your sir would be having a standard price. So even if you get the call from the client, you know what is the price for a salary return. You will say, okay, it is 5,000. That is where partly I'll say open market value may even apply to our case. But in the example which I gave you, where I'm doing computation of a business return, I will agree to this point, open market value not applies, and hence clause A fails. We have to go to clause B. I hope this is clear to everyone.
Yes, sir.
Fine, just give me a minute. Yes. So students, coming back to the point. So first part is, I hope, clear to everyone, correct?
Yes, sir.
Now
Yes.
tell me, what will be clause B in same example?
If open market value is not known, means value of that 25,000 ITR filing fee is not known. In
And it will
that
not be
case,
known. As I said, practically in this example, it will not be known. Why? Because what I have given to you, I am not giving to anybody else. So see, again, what is open market value? It is the standardized price of my goods and services. And how do you find out open market value? As per the definition, the same goods I'm supplying to somebody else, you take that price, where that somebody else is not a related person. Price is the sole consideration, means all the requirements of 15(1) are satisfied in my sales to others. That is what is open market value. But as I said, in our practice, it will be very difficult, especially in case of business returns, because everybody's business returns are different. So in my example, what services I have given to you for your return filing cannot be compared with others to whom I have given same service of return filing, because of the difference in the technicalities. Now, your value cannot be found out from the price which I am charging to others. It means there is no open market value, or the open market value fails. So you come to B. So as per B, what will be the value?
5,000 plus value of the cloth.
So what? Give me an example. Make it more specific.
Like 5,000 cash has been given by the recipient of services, and plus whatever the cloth he has given, suppose the value of that cloth is 30,000, then we will consider total value as 35,000 as value of supply.
Excellent. But now I have a doubt in this. Now you are the businessman of this cloth. Now this 30,000 value which you have taken is your purchase price of this cloth, or it is your sale price of the cloth? Possible.
Not
Now
only
there.
it will be, I think, sale price.
Okay. Now see, that is again a question, whether it is the purchase price or the sale price. Because you may have purchased this cloth for 20,000, and after adding your business markup, you are selling this for 30,000. And again, 30 is average. Average means you may be selling for 35 also, 27 also, but so 30 is your average, because you, in your business also, you are doing discounting depending upon who is paying immediately, who is taking credit, who is your regular customer, who is doing bulk buying. So average your sale price is 30 and your purchase cost is 20. So when you are applying this rule B or clause B, and you have to take the value, I agree to you, what you said is 100% correct. As per B, what will be the value? Whatever I have received from you, will find out the value of that. So 5,000 is the money plus whatever is the cloth that you have given. But which price of the cloth? So you are saying it is the sale price at which you are selling, and we take the average sale price. Yes, others are agreeing to this, or others have any other inputs in this?
Agreed.
Agreed. So it is not the purchase, it is the sale price. That is main point of discussion. Yes, all are agree. It is the sale price and not the purchase price.
Yes, sir.
Perfect. 100% agreed. Now, in my example, the answer will come as per B. But now I change the example slightly so that we can go to C and D also. So let us say I have done your return filing. Now, who are you? You are not that businessman. That is done. That is in B, it is done. You are a lawyer. And what we have agreed is that against my service of doing your return filing, I have one case to be filed against some other business debtor of mine who is not paying my fees and who is creating all different types of issues. So I want to file a legal suit against that. So what we agree between us, that I will be doing your return filing, and instead of that, or not instead means for that, you will be doing this particular legal case for me. Now in this case, again, A does not apply because what I've done in your returns, I may not be doing in everybody's return. So there is no standard price applicable. So A fails. Here B, can we apply B? Or if I have to apply B, how it will be applied? Yes, students, how B will be applied if I have to apply B?
B will also not be applied because money equivalent of non-monetary consideration may not be determinable.
So firstly, explain me in this B, how B would be applied if I have to apply.
In this case, we can check what is the value of that advocate services.
Perfect. So as in the previous example, you found out the sale value of those cloth materials. That is, you found out the value of goods which the recipient is giving to me. In the same fashion, if you have to apply B again, you have to find out what is the value of the lawyer service. So when the lawyer is giving those type of services of filing a suit against a defaulting debtor, what is his charges? Now, why I said B will fail, because same like my scenario, my services are not same for everyone. Similarly, in lawyer's case, every case is not same. Even if the case is of the matter of defaulting debtor, but in every defaulting debtor's case also the scenarios are different. He or she may require different efforts in providing his service. So here B may also not be very comfortably possible. Why? Until unless the lawyer has a standardized again service card where he charges, let us say, 25,000 for all his defaulting debtor cases. If that is the case, then my answer will come as per B. That is what is the fair market value of what I have received from the customer, which is his service. But if he also does not have a standardized rate card, he charges different fees for different case scenarios, then even B will fail. Now, if you have understood this, now tell me, if B also fails in this case scenario, how will C help me determine? So that you will understand whether C is also applicable. If not, we'll go to residuary. Yes, students, tell me. In this case scenario, I hope firstly you all will agree A and B fails. If A and B fails, now I need C. So how will C determine my value? So
In
that we
this
can
case,
check whether
there
C
is
applies or it also fails. Yes, sorry, please tell.
in the C, it is written that value of supply of good service will be determined using like, kind, and quality. Means we can use similar kind of services, like in case of advocate related services. What is the fees of similar services, and that we can take.
Okay. So one view which is coming for application of C is that I have to take similar advocates fees. This is what you are saying?
Yes, sir.
Acha, whose service we are valuing right now? This valuation is for whose supply? My supply.
Supplier service.
Yes.
Supplier, yes.
So chartered accountant service supply we are valuing, na?
Yes, sir. Chartered accountant
Okay.
services.
And for that you are saying, if I have to use C, I will have to find out other lawyers who are also doing the same service and their fees, correct? Okay. Others, what are your views? You agree, you disagree, or you have some other mechanism?
That's okay, but there also it would not be standardized services provided by the.
That is whether it is possible or not, that we'll check. But my first question is whether you all agree to the mechanism. Is
Yes,
this
yes,
what is C?
yes.
Okay, I don't agree, but yes, Chitra, you are correct. See, what is C? In C, I will try to find out similar chartered accountants service value and not similar similar lawyers service value. So what is goods of like kind means any other supply made under similar circumstances which is same or closely or substantially resembles in characteristic quality etc to the supply being valued. And that is why I asked this question, whether we are valuing CA service or we are valuing lawyer service. Our purposes of valuation is finding out value of my service, that is the written filing which I have done. For this, in return, you have given me your lawyer service. I first applied A. A was my standardized service card, not there, because I charge different value to different clients, because I do different, I have to take a different level of efforts. So A fails. B fails because in B, I have to find out what is the money value of your means lawyer service given to me. Again, this fails because again, you do not have a standard rate card. Had you had a standard rate card, I would have taken the value at which you are providing the same service to other clients, but that is also failing. So B fails. In C, I will see what other chartered accountants in my area are charging for doing the same type of returns. So let us say if some other chartered accountant is also having a lawyer as a client and more or less having similar type of activities in the lawyer's return, what the other chartered accountant is charging to lawyers, if the other chartered accountant is charging to the lawyer in money value, that money value, let us say the lawyer is the chartered accountant in my area is charging rupees 40,000 to a lawyer for doing his income tax computation and return filing, then I will apply C and take the value which other chartered accountant is doing. So what is supply of like kind means? It has to be same with my supply, not with the supply which I'm receiving. So if I have to use C, I will check the value or the price list of similar chartered accountant service, not of the lawyer service which I have received. I hope you understood the difference which I'm trying to make out. Correct, na?
Yes, sir.
We could use clause A also, the open market value of such supply, if we can find the value of such supply by comparing with
Correct.
other chartered accountants.
Correct. But the difference in A and C is this is what actually I wanted to hear. Very good, you made out this point. Then why A not and why C? Because see, the difference in A and C is in A, you are taking my price charged to my other clients who are similar clients. And in C, you are taking price charged by other chartered accountants to similar clients. I hope you got the difference.
Yes. Can you repeat? I could not understand.
I'll repeat. See, A, B, C. B is very clear. B is the lawyer's service price at which the lawyer provides lawyer service. That is value of B. A is the chartered accountant's service charge. C is also chartered accountant service charge. The difference between A and C is A is my own service charge to other clients of mine. So I have, as I said, 5,000 clients. So in my both the examples, one is of a cloth trader, other is of a lawyer. If I have to value their services, I will see if I have replica same type of cloth trader and replica same type of lawyer to whom I am providing the return filing services. And when I'm saying replica means their returns also have the same quantum of transactions and their returns also have the same nitty-gritties as what this cloth trader and this lawyer has. If I have that and I have charged them in money value, then whatever fees I have charged, that will be the answer of A. But as I said, this would be practically difficult because maybe if, except for salary returns, for business returns, it is very difficult to have a standardized price because every business return has different nitty-gritties. So I do not have a standard service rate card for business returns. So A fails. Then I have to check in the market. Now I have to go to the market. So if I have to give you a word, C is basically fair market value. A is my own value charged to my other clients. C is what other chartered accountants are charging for similar services. Let us take it other way around. Let us say this same lawyer or this same person was with some other CA up till last year, and now he has shifted to me. Maybe if I can find out what the other CA has charged to this person, I can take that as the basis in C. But that may not apply completely because that was last year's price, then the inflation and all will come. But what is the main point in C is what we call as fair market value, which is the value charged by others doing the same business. That is C. And A is value charged by me only, maybe to other clients for whom the work which I have to do is same. I hope A and C is clear now.
Yes, got it. Now it's clear.
Perfect.
Perfect.
Chalo. We'll take a short break of around 10 minutes and we'll come back and resume. Now I hope all the three values A, B, C are clear because they are repeated in the other rules also. So that is why first understanding it practically was more important because in other rules I don't have to again explain because they are same. Only the scenario is changing in 27, 28, 29. Fine. Chalo. Let us have a 10 minutes break. Okay. Now, let us proceed in this particular point further. So the example that we are engaging into is, I have done written filing for a lawyer where clause A fails because I do not have similar service given to any other client. There is no standard rate card. Clause B fails because in clause B, what I have received, I have to take the value of that. But again, what the lawyer has given to me is not a standardized service. So there is no value for that. Clause C is also failing because other chartered accountants who are providing similar service, we have to take that value, or in a simple words, we have to take fair market value. But again, understand this, even if any other chartered accountant has a similar lawyer client, but what is the difference? Understand, students. In case of service sector, especially in case of services like of ours, which is you can say a service which requires lot of skill, lot of knowledge, no two professionals can be compared. Reason one, there would be difference in their experience level. Reason two, there would be difference in their level of what you can say, the professional acumen is not same. So you cannot say that any other chartered accountant's fees should apply to me. Though practically it happens that in market, because of market forces, we align our fees so that the clients are not shifting because of fees. So this is what is the important point, that clause C is also failing in this. And that is why I particularly took this example so that we can understand the other clauses also. But I hope you all have understood what is the difference between A, B, C. Is this clear to all?
Sir, in B, I have a small doubt. Like,
Please go ahead.
the example that you explained, like, recipient of service will give money 5,000 plus cloth. So, in that case, like in the provision, it is written that consideration in money plus money equivalent to non-money consideration. So, in this case, if only cloth is given, then also we can value as per clause B only. Means if there is no money, no cash.
So see, it is not necessary that money has to be there. Na? It may be money plus non-money, or it may be exclusively non-money. For both, it is same.
Okay, sir.
Correct, na?
Yes, sir. Clear.
Great. Now, in this lawyer's example, where I have done written filing for a lawyer, A, B, C, all are failing. Then we are left with no choice but to come to D. And in D, what it says, if the value is not ascertainable by using the above methods, which is not in our case, the consideration in money, that is, if I am receiving that 5,000, plus the money equivalent of the non-monetary consideration as worked out based on cost of supply plus markup. So if I cannot find out the value from these external factors, what were the external factors? ABC are external factors, my price to others, or what I have received, the fair market value of that, or what other CAs are charging in my market, fair market value of that. If none of this is working, then what we can do is we can do my costing, which is rule 30. But again, as I already explained when we were discussing about rule 30, again, for a service sector or a person like a professional, like a chartered accountant, it is highly difficult and impossible, if I can say, to actually do costing of your services. Why? Again, because costing will only cover the physical cost. But in professionals, a major component of value is your intrinsic value, your knowledge, your experience, your professional acumen, for which costing is impossible. And that is where even rule 30 will fail for me. And that is where I would like to now explain what exactly is rule 31. Now, what is rule 31? We discuss it is the most vague rule because there is no mechanism is given. At least in all other rules, there is some mechanism given. You take my price charge to other, you take other CA's price. There is some mechanism given. Rule 31 has no mechanism. That is why you can see here they have used a term. It is also the best judgment value method. But then how this is done? We studied what does rule 31 says? You have to find out the value using reasonable means. Now, what is using reasonable means? For this, I will come back to this example. See why we were not able to find out the value in this case of I giving service to a lawyer or doing the written filing service of a lawyer, because finding out a similar service and a similar value is not possible. Because even if I have other lawyer clients, the value will not be same. Even if other chartered accountants are giving services to lawyers, it will not be same. Or what service the lawyer is giving to me, valuing is very difficult. This is where all the above rules fail. And rule 30 also fails because doing costing of professionals is again a very big challenge. This is where rule 31 helps. Now, how will the value be determined by rule 31? We will take any of the above values only. That is my fees charged to other lawyers or other CAs charging fees to lawyers. And I will take that fees only. I will do some adjustment 10-20% up and down to adjust. Let us say if I'm taking some other CA's value where what he's charging to lawyer, similar lawyer, I will take his fees only, do plus minus 10-20% for what? For the difference between me and that CA, and that will be my value. Now, this is not accurate. That is why this method is using the word using reasonable means, using the principles of this section and other provisions of this chapter. So basically, what is the provision? See, provision simply says you need to find out the value of your supply. For this, I have given you different mechanism. You take your supply to others, you take other people supply similar services, you take value of what you have received. So using these only, you determine the value in 31 by making some adjustments ad hoc. So in my example, what I will do is when I come to rule 31, I will first see, can I apply A with modification? What was A? My fees to other clients. So I will try to find out in terms of how much time I have spent on this lawyer's computation, then which level of my office employee, whether the most junior employee or some senior most or I, who has done this computation. So I will take these two things in consideration and I will try to find out similar time by similar person is given to which other client. That may be a construction client, that may be a manufacturing client, whoever, and what fees I have charged to them. I will take that fees as the base. That is under rule 31. I will apply clause A only with this modification. Or if I have to apply B, what I will see, I will ask that lawyer only, ki boss, whatever services you gave to me, give me a generalized value which you or people in your field are charging. He will say, Vishal, there is no value people charge between 15,000 to 50,000. That is reality. I will say, okay, no problem. What is the range? In your field, for similar service, you all charge between 15,000 to 50,000. Okay, I'll take average. So it is 35,000. Or C, I will go to other chartered accountants in the same industry. I'll discuss with them, ki boss, I have a similar lawyer client. What do you think should be the fees? And many times this happens. If let us say I'm getting a very new type of client to whom I have never catered to, and I want to decide the fees, many times I call up my seniors. Ki sir, this is the client and you are so much senior in this profession. So you guide me how I can do that. So he will say, Vishal, in market, normally people charge between 35 to 40,000 for similar client fees. You decide. What I will do is I'll take that 35, 45,000 range. If I feel I'm very junior in this field, I'll take 35. If I feel I'm at par with seniors, I'll take 45. If not, I'll take average. So I'm trying to give you the practical part of Rule 31, because if you read Rule 31, there is nothing given in the law. It's saying using reasonable means consistent with the principles. But what is reasonable means? This is the reasonable means, taking average. What is consistent with the principles is taking one of these values only. That is what is consistent with the principles. I hope students have understood this, how Rule 31, which is the most open-ended or most vague rule, will be applied. Is this clear to all?
Yes, sir. Clear.
Perfect. Should we proceed then?
Yes.
Now see, once you all have understood 27, 28, 29, I will not be required to explain because they are very straightforward. So what does 28 says? Firstly, where 28 applies, where the transaction is with a related person, except agents, because for agent you have Rule 29, or the transaction is with your own entity who is having a different GST number, which we call as distinct persons. How the valuation is done under Rule 28. So out of the above four A, B, C, D, here they have asked you to take three values. First, again, open market value. Second, like kind value. Or third, Rule 30 and 31. So basically what they have not considered out of the four is the B value above. What was B value? What I am receiving. You take the fair market value of that they have skipped. So instead, what you will take is your price to others or price charged by other chartered accountants for similar service. And if both these are not possible, you will take 10% above your cost, or the Rule 31 reasonable means. So let us say I am giving service to this cloth trader, I am giving service to this lawyer, and they are my related persons. How they are related? This cloth trader is nothing but my brother. Who is this lawyer? He is nothing but he is my father. Now in this case, when I am doing their return filing, I will come to Rule 28. And in Rule 28, first is I will see what I am charging to other of my own clients who are similar. That is A. B, I will connect to my other chartered accountants in the profession. I will check with them, ki, sir, what is the fees that you all charge to these type of clients? That is B. And if both is not working, C, I'll do my costing, I'll add 10%, which is not possible. So I'll take Rule 31, where I'll again apply A and B only, where I'll take my fees to other clients, but with some adjustments because I don't have same category of clients. So the same thing which I mentioned, I'll see how much time I have spent, which category of my employee has given the time, and the same time of the same employee done for some other client, how much is the fees, I'll take that. That will be A. B will be, as I said, I'll contact some senior CA. They will say ki our range Vishal is 35 to 45 and I'll take something between that. That is what is applying Rule 31 in this case. However, what is very interesting in this rule is these 2 points. Now, this rule has simplified the work. How? Firstly, it says, if the recipient, who is my related person or my distinct person, is eligible for full ITC, then I don't have to worry. I have to forget the whole valuation rule. I can even take rupee 1. And that rupee 1 will be assumed to be the open market value. It means it will be accepted as a taxable value. So you can say this is the first exception to this whole rule. It says that you forget all this ABC. Value is what you are going to charge in your invoice. Whatever you charge in your invoice, we will assume that to be the open market value and we will accept that as taxable value. But condition, my recipient is the one where the ITC is not blocked. So whatever GST I'll be charging to my recipient, the recipient who is my related person or my distinct person is having no blocking of ITC, no reversal of ITC under section 17(2). It means my GST charged, whatever I'm charging, is fully utilizable by my recipient. Then whatever price I'm taking, I have to check no valuation rule. I can take anything between 1 to 1 lakh. It will be my choice and it will be accepted. Similarly, another carve out you can say is the value can be 90% of the price charged for the supply of goods of like kind quality by the recipient to unrelated customers. Means what? Now, firstly, when this has to be applied, if the goods are intended to be supplied as such by the recipient. So now this second carve out is applicable where I'm selling goods to my recipient, who is my recipient, related person or distinct person, and who is going to act as a trader. So whatever goods I am supplying to my recipient would be as it is selling it further. Now, if this is the scenario, then this is the carve out or this is the exception given, which says that you check the price at which my recipient has sold it further. And obviously further to unrelated customer, because my recipient and I are related, but my recipient is selling to unrelated customer. Whatever price my recipient is charging to unrelated customer, take that price minus 10%. That is my taxable value. I hope you have understood both these carve outs. Yes, students?
Yes, sir. Understood.
Okay, great. Now, there is some clarification given. However, it is not mandatory for the supplier to adopt this method of valuation. So, supplier is given this 90% rule as a choice. So, supplier may opt for this, that is, I may go for this 90% rule or I may find out as per ABC. Further, it is important to note that as per valuation rule 32.7, the value of taxable services provided by notified class of service provider without any consideration between distinct person is nil if ITC is available. So this is what is in consonance with this exception, that where I am charging even nil value, that is no value. But when this will be accepted, where my recipient, who is my distinct person, or sorry, not distinct, not or who is my distinct person, is eligible for full ITC. So even if I charge nil, it will be accepted. Now, where this is applicable, let me give an example. At present, there is a big litigation open today in GST, one of the litigations, that between distinct persons, there is a concept called as cross charge. What is cross charge? Let us say I am the head office and you all are my branches. So we are distinct persons because we are entities of the same company. Only that I am set up as the head office and you all are set up as the branches. Now, there is a big open-ended litigation in GST where the department is raising notice on the head office saying that, boss, you have not charged to your branches. For what? They are saying that since you are head office, you are doing some service for the branch in the form of running the branch, maintaining the branch. So you are indirectly providing some business auxiliary service, business support service to your branches. Obviously, they are my distinct persons. Now, till date, I was not even aware that there is any such service. But now, because of some advanced rulings, this concept has been brought into GST. They are using Schedule 1, Entry 2, where even if I'm not charging anything to my branch, they are saying, since I'm managing my branch, it means I'm giving some service. And this is where they are asking me to pay GST. Now, since there was a lot of confusion, there was a lot of litigation, people going to high courts under it, they came up with this clarification, which said that where we are providing services to our distinct persons, even nil value is accepted. Again, the same condition is ITC is available, but provided this relaxation is given only for notified classes. Now, what are notified classes? That the government may come up, so they may provide this benefit to banks, to such entities where there are multiple branches and there is continuously give and take of services. So that is where they will come up with this particular type of relaxation. So this is that cross charge I was talking about. So under GST law, using Schedule 1, they have brought in this concept of cross charge, whereby they say that generally head office should be charging to the branches because head office is doing some work for the branches. And this is what is they are calling it as cross charge. Why cross? Because between the entity, one branch or one unit is charging to another. That is what is the cross charge. And now, as I said, because of lot of confusion, they have come up with circular, and the circular says the same thing what we just discussed, that whatever the head office is doing for the branches, which now they are calling it as internally generated service. So what is this internally generated service? Like, as I just explained, head office is managing the branch. So this is what is internally generated service. What is opposite of internally generated service? If I am buying something from outside and giving to the branch, like the head office procures a software, and that software is used by all the branches, that will not fall over here because that is not internally generated. So internally generated means what head office on its own has done for the branches, like all the management services. For this, they have said that if my branches are eligible for full ITC, that is, there is no blockage, there is no proportionate reversal, then whatever value I am showing in my invoice, 1 rupee to 1 lakh rupee, that will be accepted as open market value, and that will be considered as the taxable value. Second, as I said, many people never did this in first 5-6 years of GST because nobody thought that this could be considered as a supply. All this has come up because of some advance ruling. Hence, they have further clarified that even if I have not issued an invoice because I was not knowing that I am managing the branch is also service under GST. In fact, today also it is not yet confirmed because all these are only advance rulings by the advanced ruling authorities who are none other than the GST officials. So it has to be still decided by the honorable courts. The matters are pending. Whenever it will be decided, it will be finalized. So till then, they have given this relief also that even if I have not issued any invoice, but if my recipient, that is my branch, is eligible for full ITC, me not issuing invoice is also accepted because it will be assumed that I have issued a nil invoice, and nil is also a value which will be considered as open market value. In short, for me not issuing invoice, there will be no challenge. Now the only problem is where my branches are not eligible for full ITC. When this happens, when my branches will not be eligible for full ITC, where my branches are engaged in any such activities which are partially taxable, partially exempt, or are fully exempt. So whenever what they are doing is partially taxable, partially exempt, in such cases, whatever I have given to my branch will be not eligible for full ITC because their outward is partly taxable or fully exempt. In such cases, they are not allowed to utilize the full ITC as per 17.2. They have to proportionately reverse. Now, where this happens, all the above benefits of any value accepted, nil value accepted will go. And now they are saying, if I am providing any internally generated services, in respect of those internally generated services, I will have to do a cross charge. Now, the only question is, what will be the value? So here they have clarified that whatever is the cost of running my head office, that cost, adding 10% on that will be the value, which is they are using rule 30. However, in this, they have said that the cost of salary of employees to the of the head office involved in providing the said service is not required to be added. So what they have said that my employee salary I may exclude. Excluding salary, all other costs which I'm incurring, I'll add up that cost. 10% of that, this will be my charge to the branches. So this is how they have given this particular circular, where they are saying that depending upon whether my branches are eligible for full ITC or not, you have to take one of these routes. Then in this next part is where one is outside India, one is inside India. So where it is export of service, no challenge, there will be no GST. Where it is import of service, same logic applied. If I am eligible for full ITC, that is the importer or the branch which is in India, which is receiving the service from the head office, and head office is outside India, whatever value declared on the invoice is accepted, and even no invoice issued is accepted. So this part is same. Now coming to another issue in this category, that is value of corporate guarantee service. Now what is this corporate guarantee? Let us first understand this, then we'll see what is the valuation and all given over here. So the corporate guarantee is what? So let us say I am one of the small companies. You are the large company and you are having more than 25% shares of my company. So as per the definition of related person we discussed in the previous class, you become my related person because you are holding more than 25% of my shares or you are indirectly or directly controlling me. So majorly this will come in holding subsidiary scenario because you are having 51% or more, automatically you become my controlling company. Now in such cases, let us say this subsidiary is going for a bank loan. Many times what happens if this subsidiary is a new company, it is a small company, the bank may not be inclined to give loan to the subsidiary. In such cases, what happens? My holding company, who is an established company or who is a bigger company with big market stake and good, strong financials, they tell the bank that, okay, see, this is my subsidiary. You can see the shareholding. Hence, I take guarantee of my subsidiary. So, my holding company is standing as my guarantor with the bank. So, the bank is happy because they are getting a very rich guarantor. So, they are ready to give me the loan. First example. Second example, I am a new company. It is not the case of holding subsidiary. It is a normal case. Again, I go to the bank for loan, but the bank says, sorry, you are a new company. You don't have any past financial records. How can I give you loan? But one of my directors is a very influential person. So one of my promoter or directors, again, is having strong financials, having a good market repute. So this director tells the bank that don't worry, you give loan to this company. It is my own company. I am one of the lead promoters, directors. So I stand as a guarantor. Now, in both these examples, what is common? Either my holding company is standing as my guarantor to the bank, or one of my director promoters is standing as my director to the bank. Guarantor to the bank. And in both cases, the common thing is that this holding company or this director is my related person. Now, here comes Schedule 1. When this holding company is standing as a guarantor on my behalf, or this director is standing as a guarantor on my behalf, Schedule 1 says, or not Schedule 1 is saying this, but this is how again AAR, AARs have interpreted this, and this has become again a similar issue like the above one, that these guarantees are in the nature of a service. So when my holding company or my director gives guarantee to the bank for my loan, it means they are giving me a service. Which service? The service of providing corporate guarantee. So understand students, what is this corporate guarantee? So corporate guarantee is where for a corporate, like a company like me, I am taking a loan and somebody is giving a guarantee for this. Now, this guarantor, if that guarantor is my holding company or my director, obviously they are not charging me any charges or fees generally. Why? Because they are doing it because I am their company only. But the law is so drafted in Schedule 1 that AAR, AAR have interpreted it saying that this is a service. Which service? Service of providing corporate guarantee. And even if my holding company or my director has not charged any fees to me, still there is a deemed supply, Schedule 1 supply between related persons, and there is GST. Now, again, after a lot of disputes and lot of confusion, again there is a circular, or rather, here there are two, three circulars where they have come up this with this valuation. For this, firstly, the circular is presuming it is a supply. And then it is saying, what is the value of this supply? The value of this supply is 1% of the amount of guarantee offered, or if they are actually charging me any price, that price, whichever is higher. So This is this service, corporate guarantee service, where the circular says that we will assume the value of this as 1%. And where you have actually charged, let us say this holding company is actually charging me some price, some fees for this. Still, this valuation will apply because they will be taking higher of the two values. Now, all these circulars are under challenge with the courts on two grounds. First, is there actually a supply? Because simply because of Schedule 1, you cannot assume anything to be a supply. So that challenge is common between the above scenario and even this scenario. And second, the other challenge is that whether this assumed valuation of 1% is arbitrary or it is legal. So these things maybe next 2 to 3 years we'll get to know when honorable courts decides. But for the time being, as per this circular, this is the valuation. Now again in this, there are some clarifications. When this circular came, the first challenge was that this particular per annum was not given. It only said 1%. Now you know that a loan continues for a period of time, maybe 8 years, 10 years. So the question was whether this 1% is one time value or it has to be considered as value every year. So they came up with another circular clarifying the previous circular and saying that this 1% which we have given in the previous circular is to be read as per annum. Then there was another circular clarifying that if let us say this guarantee is given in between the year, like let us say today I have taken this loan and you are standing as a guarantee, this 1% is per annum, so it has to be proportionated because this year from today up to 31st March, whatever is the number of days, you will proportionate that 1% value divided by 365, multiply by this proportionate period, and that will be the value. So this is how further circulars have come clarifying how this 1% has to be applied. Again, same point, same relaxation which was given above, that where my recipient, my means sorry, here I am the recipient. So where I am eligible for full ITC because entire my outward supply is taxable, there is no exempt, then this 1% and all is not required. Again, whatever value is declared in the invoice, whether it is 1 rupee or 1,000 rupee or 1 crore rupee, that will be accepted, that will be deemed to be the value of the service. So same relaxation as given above is continued here. Now, some more clarifications. As I said, after the circular had come, there was more confusion. So further circulars came clarifying certain things. What is the first point which they clarified? Loan only partly availed and not availed at all. Now, what is this clarification? So you understand that many times when it comes to loan, we sanction a higher amount, but we utilize only part amount, or maybe in this year only the loan is sanctioned but actually no disbursement or no utilization has happened. So let us say today I just get a loan sanctioned of 100 crores from the bank where my holding company or my director has standed as a guarantor for me. The loan is passed, the loan is sanctioned, but this whole year up to 31st March, either I have withdrawn only 20 crores out of 100, or let us say I have not withdrawn anything because right now I don't use it, require the money. I'll require it maybe next year. Now the question is, where only the loan is sanctioned, but no withdrawal is happening, whether you still take this 1% value? That is what is answered. Can you please read this part better?
Yes, sir. Loan only partly availed or not availed at all. In cases where the loan is only partly availed or not availed at all by the recipient, value of supply of corporate guarantee will be calculated based on the amount guaranteed and not based on the amount of loan actually disbursed to the recipient. Further, the recipient would be eligible to avail full ITC irrespective of when the loan is actually disbursed to him and irrespective of the amount of loan actually disbursed.
So what is clarified in this first point? That this valuation will apply only on the basis of loan sanction, not on the basis of money utilized. So even if I am not utilizing a single rupee, still this valuation will apply. Now, I personally do not agree to this, but Fine. This is what is the first clarification given in this particular rule. Read the second one.
Takeover of existing loans. In case of service of corporate guarantee, service provider is corporate entity providing said guarantee and recipient is a related entity for whom guarantee is provided. Thus, in case of takeover of existing loans by another banking company or financial institution, there is merely an assignment of an already issued corporate guarantee. Said activity of taking over of the loan does not fall under service of providing corporate guarantee to any banking company, financial institution by a supplier to a recipient. Thus, GST will not be payable again unless there is issuance of a fresh corporate guarantee or there is a renewal of existing corporate guarantee.
So let us say my present loan is with SBI. I'm shifting it with, let us say, IDBI. You are my guarantor in SBI, and obviously you continue to be my guarantor with IDBI. Now, whether switching of this loan will again be taxable, because at least on the documentation front, there will be hold together a new document, a new guarantee, this bond will be executed by you. So whether it will be said that in this year you have again given a guarantee, and the answer is no. Already at the start of the year, we took 1% value for the whole year. That 1% was taken for this loan, whether it is with SBI or in between the year it is switched to IDBI. That will not change the answer, means there will not be again a value. The value remains the same, that is 1% calculated at the start. So mere switching of loan will not become another service. Please read.
Yes, sir. Intra-group corporate guarantee, where domestic corporate issue intra-group guarantees, GST is to be paid under forward charge mechanism and invoice is to be issued by the supplier of service of providing corporate guarantee to the related recipient as per section 31. Where corporate guarantee is provided by foreign or overseas entity for a related entity who is located in India, GST would be payable under reverse charge mechanism by the recipient of service, that is related entity located in India.
So what is clarified? If it is given by a domestic holding company or a domestic director to me, the tax will be charged by them under forward charge. Whereas if it is given by a foreign company to me, for me, it will be taxed under reverse charge mechanism. Similarly, if it is vice versa, I am giving guarantee for some foreign company, then it is as good as export of service. And in such cases, above provisions will not apply and there will be no tax because the recipient is outside India. Then if corporate guarantees for multiple years, now this is again important. Please read.
Value of supply of said service provided for a particular number of years shall be 1% of amount of such guarantee offered multiplied by the number of years for which the said guarantee is offered or the actual consideration, whichever is higher. GST is payable at the time of issuance of such guarantee. Where the corporate guarantee is provided for a period less than 1 year, for example 6 months, then in those cases as well, the valuation may be done on proportionate basis for the said period. That is, in this case, value of the said supply of service may be taken as half of 1% of the amount of such guarantee offered or the actual consideration, whichever is higher.
So this is simple. This 1% is value per annum. If the guarantee is for multiple years given at one time, 1% will be multiplied by the number of years. If the guarantee is for part of the year, as I said, I take a loan today. So from today, the balance period is, so the balance months or days would be counted and proportionate value will be taken. Next, corporate guarantee by multiple related parties.
In cases where corporate guarantee is being provided by multiple related entities, co-guarantor, we first need to determine which of the two value is higher sum of actual consideration paid to co-guarantors, or 1% of total guaranteed amount. If total actual consideration is higher, value of supply will be sum of actual consideration paid or payable to co-guarantors. If 1% of total guaranteed amount is higher, then GST shall be payable by each co-guarantor proportionately on 1% of the amount guaranteed by them.
So another clarification is there are multiple guarantors. So let us say the bank is not satisfied with one of my holding company giving guarantee or with one of my director giving guarantee. They want 2-3 persons giving guarantee. Then this 1% will be divided between them. So it is not 1% per guarantor. 1% is for the whole loan. Loan amount into 1% is the value of the service, divided proportionately between the directors or the persons who are standing as a guarantor. So this is what is the point that we just discussed above relating to corporate guarantee. Now here there is this interesting part relating to RBI guidelines. So please read this part, valuation of personal guarantee by directors.
Yes, sir. Valuation of personal bank guarantee by directors to bank for the company. Let us first analyze whether the activity of providing personal guarantee by the director of a company to the bank or financial institution for sanctioning of credit facilities to the said company without any considerations will be treated as a supply of service. Since director and company are related person as per explanation 15, a. The activity of providing personal guarantee by the director to the bank or financial institution for securing credit facilities for their companies is to be treated as supply of service, even when it is made without consideration as per section 7.1c, read with para 2 of schedule 1. As seen above, value will be open market value of such supply. However, as per the mandate provided by the RBI guidelines in this regard, no consideration by way of commission, brokerage fees, or any other form can be paid to the director by the company directly or indirectly in lieu of providing personal. Sir, in the blue. Personal. Consequently, there is no question of such supply transaction having any open market value. Accordingly, it is clarified that open market value of said transaction or supply may be treated as zero and therefore no tax is payable on such supply of service by the director to the company. However, in some exceptional cases where remuneration is payable to the director, the taxable value of such supply of service shall be remuneration consideration provided to such guarantor by the company directly or indirectly.
Now this is a very important point that there are RBI guidelines which say that there will be no commission or brokerage payable to director where the director is providing a personal guarantee. Now, interestingly, the circular says that obviously it cannot go beyond RBI guidelines, so it cannot make it taxable. So, firstly, it is saying that okay, we will also consider it as nil. However, so it says that it is clarified that OMV of the said transactions may be treated as zero. Interestingly, it is using the word may. Not, it is not saying it will be zero, it said it may be zero, and no tax may be payable. However, again, this part is the interesting part. In exceptional circumstances, where remuneration is payable to director, the taxable value shall be the remuneration provided to such guarantor by the company. So they are saying where any consideration is payable, then we will apply this valuation rule. So this is what is the rule 28, which out of all the three rules, I believe is to be considered very important for the perspective of exams. So I request that you all prepare this rule 28 thoroughly with all these different limbs, especially these two circulars, one clarifying the overall management service by head office to branch and the other clarifying about the corporate guarantee which either the head office gives, the holding company gives to subsidiary or director gives to the company. Then come to another rule, Rule 29, which deals with the case where the goods are supplied through or by the agent. And in such cases, the value will be 1, open market value, or where the agent further supplies, the sale price of the agent minus 10% will be my value. So it will be the 90% of the price charged for the supply of goods of like kind or quality by the recipient to the unrelated customer. So in this particular case, the valuation given is only between 2 points. And again, this is my option to choose between another one. So first is taking the open market value where, now see, if it is of goods, there is a chance that there will be an open market value because the same goods are supplied to so many other persons. So what I'm giving to agent, I'm also selling directly to other customers. Then whatever price I'm charging to customers will be the open market value. That will be the value. Or whatever price my agent further charges to the customer to whom the agent is selling my goods, that price minus 10%. That will be my taxable value. So this is what is rule 29 sim. And again, besides this, we all know you have these two residuary rules applicable where this fails 110% of cost or the reasonable value method, that is rule 31. Now students, once we have completed up to this, now we come to the specific rules. Specific means rules which are applicable to one-off cases. Now these rules, many of them are added in past 1 or 2 years considering some recent scenarios. So let us go to these rules one by one. So first is rule 31A, value of supply in case of lottery, betting, gambling and horse racing. Correct? Please read the table.
Supply. Supply of lottery by the organizing state. Organizing state means the state government which conducts the lottery either in its own territory or sells its tickets in the territory of any other state. Supply of actionable claim in the
No,
form of
read the value. Read the value first.
Okay, sir. Value. Value will be determined as follows. How higher of two amounts to be deemed as the value. 100 by 128 of face value of ticket or 100 by 128 of the price as notified in the official gazette by the organizing state.
So what is this? So firstly, we are talking about supply of lottery and it is done by the organizing state. What is the state? It is the state government which is running the lottery. Now, where the state government is running the lottery, what will be the value? The value will be higher of the two amounts. First is 100 upon 128 of the face value of ticket. What it means? See, let us say a lottery ticket is of rupees 500. Now it is assumed that this 500 is including GST. So how we make back calculation? The same thing will apply over here. 500 divided by 128 because we are assuming 28% GST is included into 100. This will give you the taxable value by back calculation or 100 upon 128 of the price as notified in the official gazette. So either the price is in the lottery, the face value of the lottery ticket, or if there is any price notified. Then the second part is very simple, supply of actionable claims in the form of chance of winning in betting, gambling or horse race. So for other things like betting, gambling, in the case of horse racing, the value is simply 100% of the face value of the bet. So if you have put a bet of 1 lakh rupees, 1 lakh into 28% is the answer. Simple. I hope this is understood and clear. Yes.
Yes, sir. Clear.
Next. Next, beta 31B.
Yes, sir. Value of supply of online gaming, including online money gaming. So value of supply is as follows. Total amount of money a player pays or deposits with the gaming platform Any form of payment, even in form of virtual digital assets like cryptocurrencies, are also included. Below, even refunded amounts are included in the value of supply.
Now, what is this? See, we are talking about valuation of online gaming. Now, for this online gaming, the value is simply the amount which you have put in the what you say. See, when you go to any of these online apps, you have to create a wallet. So whatever amount you have put in the wallet. Now, what is very interesting, or what is even very strange, even though you have not used the money for playing any game, the moment you put the money in your wallet, that's it. That becomes the value. And on that value, you pay 28%. So, what is very strange is that in case of online money gaming, they are not going to take the value which you have actually used to play the game. The value is simply the value which you have deposited in the account. That is taken as the taxable value. Of that value, you directly take 28%, and that is your GST. What is even further clarified, let us say you withdraw some amount from that, like either because of winning, or let us you don't want to play and you withdraw some amount from your wallet, there will be no reduction because the tax is charged to you at the start itself. When start? The start when you had deposited the money. So after that, whether or not you utilize the money, whether you are withdrawing the money, in all these cases, the tax will remain the same. There will be no refund given to you. This is what is the most important point relating to valuation for online money gaming. Is this clear? Yes, proceed.
Yes, sir. Value of supply of actionable claims in casino as per Rule 31C. Amount paid for purchase of tokens, chips, coins, or tickets, etc. in casino, plus money spent to participate in any game, scheme, competition, or any other activity where tokens or chips are not needed, like direct entry fees. Even
So
refunded amount are included in the value of supply.
now see, when you go to a casino, for playing in a casino, what you have to do is you have to buy those chips or coins or tokens, whatever you call it, right? Now, when you buy those chips or coins, whatever money you have spent for buying those chips or coins, that money is your taxable value. Simple. Again, here also the same point is given. Let us say after playing the game, you refund back the money. When you refund back, you will get some amount returned, but that will not be deducted. So the answer is simple. The answer is what will be your value? Your value is the amount which you have spent for buying that token or chip. So when you go to a casino for playing any game in the casino, you have to buy those tokens and chips. That token or chip is the value. Simple. Similar to online gaming here also, whether you utilize that money or not in actually playing some game, that will makes no difference. It will be the taxable value. Secondly, if let us say you are not buying any token or chip, but you are directly participating in any game by making payment of money, then that amount whichever you have paid for playing that game is the taxable value. So whenever you go to a casino, we put a bet either by first buying the chips and coins and we put the chips and coins as the bet, or directly we put the money as the bet. So whatever money you are putting as the bet, that is your taxable value. And if you are using the chip or coin route, whatever you have spent on buying the chips and coins in the first place, that is the value. Even if later on you return back some chip and you get back the money, there will be no refund at all. So similar to online gaming, this rule is provided. Please read this point.
For the purpose of Rule 31B and Rule 31C above, any amount received by the player by winning any event, including game, scheme, competition, or any other activity or the process, which is used for playing by the said player in a further event without withdrawing, shall not be considered as the amount paid to or deposited with the supplier by or on behalf of the said player.
Now, what is this? Now, this point applies to both the above rules. Now, let us say I first put 100 rupees in my wallet for playing a game. Now, since this is money game, let us say I win that game, so I receive 500 in the wallet. Now, I use this 500 to play further games. Now, when I use this 500, there is no tax on this 500. Similarly, in casino, I have bought chips of 10,000. Now, when I put 2,000 as bet in one of the casino games, I won that game and I received 20,000. Now I am having chips of 20,000 plus extra whatever was left with me. When I use this winning amount to play further, there is no GST on that. So what is clarified is GST is levied once only on the original amount of chip purchased by you, or in case of online money gaming, the amount put in your wallet. If you win anything from this game or casino and you again reutilize it, there will be no further GST on the win amount which you are reinvesting. So that is where this particular point is important, that it is only once that you will have to pay GST. So if you win and you reinvest the winning amount, there is no GST on this particular point. So just keep this particular thing in mind, that in case of online gaming and casino, only the first amount that you deposit is what is taxable. Now we move on to some further supplies for which valuation is given. So there are 5 different supplies for which Rule 32 provides valuation. Rule 32 override other rules. So for these specific supplies, we will not apply the above rules, whatever we studied till now, because there are specific rules given. The valuation method prescribed under 32 are optional. The supplier can use them if he so desires, or he can also opt to value his supplies in accordance with other valuation rules. So what is important is you are having the choice of following other rules. So these rules are not made compulsory, they are optional. Now, what are these supplies which are covered? Let us go to each of these supplies and find out the method of valuation. Now, the first method of valuation or the first supply which is covered is in relation to conversion of foreign currency. Now, we all know that if, let us say, I want to do some import. For doing import, I will require some foreign currency, maybe in the form of dollar or euro or ruble or whatever it is. Now, what I will do, either I'll go to a bank who is the authorized bank for exchanging money, or I will go to authorized money dealer and I will ask them that, boss, give me 1 lakh of dollars. They will give me an exchange rate, that today's exchange rate is, let us say, rupees 90. So I have to pay them 90 lakhs. Now, besides paying them 90 lakhs, they will charge me some fees, some processing fees, which may be for conversion of this particular exchange. Now, if they charge me a fees, there is a value, the tax can be levied on that value. But many times, these banks or money changers may not be charging me an express fee. Why? Because to sell this dollar to me, they are also buying this dollar from someone. Many times their value is the margin that they are earning, because they are buying it at, let us say, 89 rupees and giving to me at 90 rupees. So they are earning 1 rupee. So where there is any such thing, how the valuation has to be determined, how these banks or money changers will be valuing their service, the services of change of currency. That is what is provided. And here, as you can see, there are 2 options given. So there is method 1 and there is method 2. Method 1 is giving one straightforward answer. Method 2 is giving slab-wise answer. And again, the supplier has a choice of following one of these methods. So please read the first valuation rule in this
Yes,
category.
a special provision relating to the determination of value of service of purchase or sale of foreign currency, including money charging as per sub-rule 2. The value of service in relation to purchase or sale of foreign currency, including money changing, is determined by either of the 2 methods. Method 1. Case number 1. Transaction where one of the currency exchange is Indian rupees. The value of supply will be difference between buying rate or selling rate of currency and RBI reference rate for that currency at the time of exchange multiplied by total units of the foreign currency. However, if RBI reference rate for a currency is not available, then the value of supply is 1% of the gross amount of Indian rupees provided or received by the person changing the money.
So simple. What is the first method? As I said, when a bank has to give me dollars, the bank will also get the dollars from someone, maybe RBI or some bigger bank, and definitely they will be getting some lower price so that that bank can also earn. So first value is simply this difference. So let us say bank has sold the dollar to me at rupees 90, but bank has procured it at rupees 89. So 1 rupee per dollar is what the bank has earned multiplied by the number of dollars which the bank has given to me. So I'm taking 1 lakh dollars. So 1 lakh multiplied by 1. This is the value. So first is the value is the difference between the buy rate and the sell rate. First option. Second option is if this buy rate sell rate is not available. Why buy rate sell rate is not available? Because for this you have to refer to the RBI rate. Now RBI may not have provided rate for every currency. So let us say I want a currency of some very small country. Let us say some African small country. And for that, the RBI has not given any of its reference rate because that is not a commonly traded currency. In such cases, also, this rule provides a simple answer. So it says that you take 1% of the gross amount of Indian rupees. So in exchange of this foreign currency, definitely from one side, there is Indian rupees. So let us say I'm buying this 1 lakh of that South African currency. And against that, I am paying only 40,000 rupees as the Indian currency because there is a chance that Indian currency value would be higher. So what will be the value in this case? If there is no RBI buy rate, sell rate available, then it will be simply 1% of this 40,000. So the answer will be 400 rupees. So first method is if you know the actual RBI rate, exchange rate, take the difference of buy rate, sell rate. If not, take 1% as the value. Now there is another method given for the same scenario. Please read.
Method 2. The person supplying the service may also exercise the following option based on slab rates to ascertain the value of service. However, once opted, he cannot withdraw it during the remaining part of the financial year. Um, Falling are the slab rate. Up to 1 lakh, value of supply will be 1% of the gross amount of currency exchange or 250 rupees, whichever is higher. Second slab, greater than 1 lakh but up to 10 lakh, value of supply will be 1000 rupees plus 0.5% of the gross amount of currency exchange minus 1 lakh. Third slab, exceeding 10 lakh rupees, value of supply will be 5500 plus 0.1% of the gross amount of currency exchange minus 10 lakh or 60,000 rupees, whichever is lower.
So students, as you can see, this is same like your income tax computation slab method. So let us say I have exchanged the same answer. I want 1 lakh dollar. So for 1 lakh dollar, I have to pay 90 lakh rupees. So how the valuation will be done by this method? Out of the 90 lakh rupees, first 1 lakh, the value is 1%. So 1 lakh, 1% comes to 1000. Now they have said 1% or 250, whichever is higher. When this 250 will be coming into picture, if I have exchanged a very small amount, which is not exceeding 1 lakh, but my amount is exceeding 1 lakh, it is 90 lakhs. So for first 1 lakh at 1%, it is 1000. Then between 1 lakh to 10 lakhs, that is for this 9 lakhs, it is 0.5. So 0.5 into 9 lakhs, it is coming to 4,500. So up to 10 lakhs, the amount will be 5,500. 1% on 1 lakh and 0.5% on 9 lakhs. So this is how for first 10 lakhs, the value is 5,500 plus. Now I have exchanged total 90 lakh worth of dollars. So 90 lakhs minus 10 lakhs on 80 lakhs, it will be 0.1%. So that will come to how much? 80 lakhs into 0.1%. So it will be 880, I think 8,000. So 5,500 plus 8,000. This will be the total value or 60,000, whichever is lower. So this one is coming as lower. So this is how the valuation is done by the slab rate method. I hope this is clear to everyone.
Yes, sir, clear.
So this is for foreign currency exchange valuation. Now we come to the next specific service in this. Please read.
A special provision relating to determination of value of service of booking of tickets for air travel by an air travel agent as per
Just
sub-rule
remember
3.
one thing. We are not talking about the airline service. So for airline, the value of the service is the value of ticket. Now in ticket also, if you look at the airline ticket, so let us say I am traveling from Bombay to Delhi. The air travel fee, sorry, not air travel, the flight, what the Indian Airlines is charging to me, the charges is 10,000. But if you look at the invoice, there is three components. So first component is what they call as the basic fare. So out of 10,000, the basic fare is 6,000. And then there is some port charges, there is some other charges, and that together makes it 10,000. Now, we are not talking about the valuation of the airlines. That is already done because airlines is giving me this fees. But let us say I'm booking this ticket through an air travel agent. Now, one thing is, air travel agent is giving me a charge of 500. He's saying I'll charge 500 over and above the ticket value. No problem, that 500 is the value. But you have to understand that the air travel agent is getting some commission from the airlines. What is the valuation of that commission? That is what is given. So it is simply if what is booked is a domestic travel, then it is 5% of the basic fare. And if it is international, it is 10% of the basic fare. Now, what is basic fare? I have already explained. In the total ticket value of 10,000, the airlines has given that the basic fare is 6,000 because other things are different port charges and other charges. So commission is paid by the airlines only on the basic fare. So that basic fare for domestic travel, the value is 5%. For international, it is 10%. So this is what the valuation rule has given straightforward. And please remember, this is only for the air travel agent services. That is the commission that they are getting. Now, when we come to this service is about the service of life insurance company. Now, interestingly, above service was not of airline company, it was of airline agent. Now, even in case of insurance, we have agents, but here the service valuation is not of agent. Here the service valuation is of the insurance company service, that is of the policy. Now it may be of no use after 22nd of September because now on life insurance, you all know that the GST has been removed. But for personal life insurance, it has been removed. For all corporate life insurance where they are taking for their partners, directors, etc., it may continue. But this rule will now be having very less utility because from 22nd of September, all personal life insurances, GST is removed. But what is the rule? Now, important to notice, in life insurance, there are two types of policies. One is the endowment policy and one is the term policy. What is the difference? See, when you take life insurance, generally the policy that we know in life insurance is the endowment policy. What is this endowment policy? This endowment policy is that let us say I have taken the policy of 20 years. If nothing happens to me up till this 20 years, at the end of this 20 years, I'll get a lump sum amount. So let us say I've taken a 1 crore rupee policy. So this 1 crore will be given back to me after 20 years. That is the what we call as maturity. Then this life insurance is an endowment policy, and majority of us we know this life policy only. But there is something else called as a term plan. What is a term plan? See, in case of endowment, if the premium which I am paying per annum for this 1 crore policy is, let us say, rupees 4 lakhs. Please understand, students, in an endowment policy, since they have to return me back 1 crore, what they are doing, the 4 lakhs that they are taking to me, they are keeping some part out of this 4 lakhs towards insurance, let us say 50,000. Remaining 3.5 lakhs, they are investing in some bonds, government securities, etc. Why the insurance company is investing? Because the insurance company has to repay back me 1 crore if nothing happens. So out of this 4 lakhs, only 50,000 is going towards my insurance and 3.5 lakhs is going towards investment. That is why In case of endowment policy, entire premium is not considered as the taxable service because out of the premium, only small part is the portion for insurance. But if you take a term plan, what is a term plan? If anything happens to me in this 20 years, I will get 1 crore. If nothing happens to me up to 20 years, the policy ends, no return. And that is why for term plans, the premium is also very low. So maybe in a term plan, the insurance company will be charging me only this 50,000 rupees, which is the actual component for insurance. So understand this. Why this rule is required? This rule is not required for term plan policies because for term plan policy, whatever 50,000 premium they are charging to me, that is only for insurance. So entire 50,000 is the value of service. This rule is not required. This rule is required for endowment policy where they are charging me rupees 4 lakhs. And out of 4 lakhs, a major portion is going for investment on which there is no GST because investing function is outside GST, we all know, because it is transaction in money. What is in GST is only the insurance service. Now there are two possibilities. One, the insurance company has mentioned in the policy document itself that out of 4 lakhs, 3.5 lakhs is investment and 50,000 is the premium towards your actual insurance. If it is given in my insurance policy itself that out of 4 lakhs, 50,000 is only for insurance, 3.5 lakhs is for investment, again the valuation rule is simple. It says that 50,000 is the value. But the percentage given over here, as you can see, there are some percentages given. When this percentage will be required, when firstly my policy is endowment policy. Secondly, this policy does not specify how much of the premium is towards insurance and how much of this premium is towards investment. If this is not given, then I will require the percentages. Correct? So see what is the valuation given. Where the policy is with only risk cover, this is what is the term plan. The answer is taxable value is entire premium. So my example of 50,000, where I am taking a term plan where it is only for insurance, nothing for investment, then entire 50,000 is the taxable value. However, where I am taking a policy which is with dual benefit, risk coverage plus investment, which is called as endowment policy, then two possibilities. One, the policy itself specifies how much is towards investment. Then what is the taxable value? It is the gross premium less amount allocated for investment, which is intimated to the policy holder at the time of taking the policy itself. So here also valuation is simple. 4 lakhs minus 3.5 lakhs, which is specified, will be going for investment deducted. So 50,000 is taxable value. But where the policy is endowment and the policy is not giving the breakup, then you will require the valuation, which is assumed to be this percentage. Two possibilities. It is a single premium. I have to pay premium only once, then nothing paying in entire 20 years, or I have to pay premium every year. If it is a single premium policy, then the value is assumed to be 10% of the premium charged. So the law is presuming that out of total premium, only 10% is towards insurance, 90% is towards investment if it is single premium. If it is annual premium, that is for entire 20 years, I'm going to pay premium, then 25% of the first year premium is assumed to be towards insurance, balance towards investment, and thereafter, from the second year onwards, 2.5% of the premium is considered to be towards insurance. So in case of endowment policy, where the policy does not give the breakup, this is the assumed valuation. And then comes a very interesting valuation, which is for sale of second-hand goods. But what is very important is many people confuse that this valuation is applicable to me also. Let us say I'm a chartered accountant and I have many of my assets like computers, laptops, which I'm using in my office. And after 2 or 3 years, I'm selling them so that I can buy more high-end systems. So when I'm selling this, they are sold as second-hand. So for me, this rule is applicable. This is the misunderstanding, but this is not applicable to me. This is applicable only to the dealer of second-hand goods. I am not the dealer. I have bought these goods for my business. I use the goods, and after using, now I'm selling it as second hand. For me, this is not applicable. Whom it is applicable? So it is applicable to that person who is dealing in second hand laptops, second hand computers, second hand cars. As you find nowadays, this is a very good flourishing business, second hand cars. So you even find so many online, this True Value and Car Dekho and so many apps where the apps are acting as the second hand goods dealer. Now for them, what is the valuation saying? As you can see the name, it is called as the margin scheme. So let us say these second hand dealers are buying the car for 5 lakhs, doing some refurbishing, some repairs and selling it to you for 7.5 lakhs. For them, the rule says if on the purchase, where you purchase the car for 5 lakhs, either there is no GST. Why? Because the supplier is individual, he is not liable for GST, or the GST is charged, but you are not taking the credit. So if you are not taking the credit on the purchase side, then only this margin scheme is available. See, normally GST should be on the sale value. Your sale value is 7.5 lakhs. But if you have not availed the purchase side credit, then you can go by this margin scheme. 7.5 lakhs minus 5 lakhs, do the difference. This 2.5 lakhs is the taxable value. Now it may happen that at times you are selling the goods for loss. So you had purchased this car for 5 lakhs. Now it is 2-3 years, this car is not getting sold, and now this model is out of the market. People may not prefer it. So let us say there is some customer who is ready to pay 4 lakhs. You are ready to buy so that at least you get free of that particular non-moving goods. So you are selling it for a loss. Obviously the GST will be zero. So where this margin scheme applies, firstly, you should be a dealer of second-hand goods. Second, you have not taken the ITC on the purchase side. Then this margin scheme says you pay tax on the difference. That is 2.5 lakhs in my example. And if the difference is negative, no GST applicable. And then comes special provisions relating to redemption, relating to determination of value of redeemable voucher, stamps, etc. What is the value? The value of token, voucher, coupon, stamps, which is redeemable against supply of goods service, is equal to the money value of the goods or service redeemable against such. Now, again, this valuation rule is not applicable because earlier there was a confusion whether there will be any tax on this vouchers, coupons, tokens. Now it has been clarified that the voucher, coupon, tokens are neither supply of goods nor supply of service. So practically this rule also will now not be applicable. But what does this rule says? What is the value of this voucher token which is sold? It will be the value at which it is going to be redeemed against the supply of goods service. So in simple words, it is the money value of goods or service which you can buy by making payment of this voucher or tokens. So where vouchers or tokens are sold by a company to you, then the value of the vouchers or tokens is simply equal to the value of goods or service that can be purchased against these vouchers. And then last comes special provisions relating to determination of value of services provided by notified service providers and the transactions between distinct persons. We already studied above that the rule says the value will be taken as nil. However, as of now, no services have been notified under this category. Is this clear to all?
Yes, sir, clear.
Fine. Should I cover this one more point, pure agent, or should we take it up in the next class? Yes, students?
Next class will be better, sir.
Yeah, because it is slightly lengthy. So no problem. We stop over here. Next class, just remind me to take this valuation of pure agent, so that the last part also will be completed. So students, today we discuss different types of valuation mechanisms provided in valuation rules. The valuation rules are of two types. One is generic rules, one is specific rules. Generic rules are to be applied where 15.1 condition fails and you come to 15.4. Specific rules are to be applied where you come to 15.5, and through 15.5 you come to these specific rules. So with this, we end our today's class. Kindly read the whole chapter again, so that if something is not clear, we will be addressing this when we will be covering the last part of this chapter in the next lecture. So thank you, students. Thank you very, very much.
Thank you. Thank you.
Thank you.
Thank you, sir.
Thank you. Good day. Yes, Ashok ji. Good day.